Guys, this is the moment I have been waiting for. Google is getting slapped.
Oh, wow!
It didn't do so well in earnings, and the stock price has been going down. And it's gotten to a point where I mentioned in one of my previous videos, you can watch it up here, where I said, if this company goes beneath $100, this is in a buy territory for me. And guys, currently, at the time of recording this video, it's at $90.47. Now, I don't know what the after hours ended up being. I'm pretty sure it went up a little bit. But needless to say, this stock price is down to $90 a share. From the 52-week highs of $151, now we're in the $90 range. Where, like, the last time we ever were at that point, when was that? Literally last January 2021. So pretty much last year, it was around this amount. And take a look at this board here. We're ranking this company 8, 9 out of 10. Now, what does this board actually mean? This just grades the financial statements of the company, so you actually have an understanding of where this company is in terms of its financial strength. 9 out of 10. This is a phenomenal score. They're doing so many things right. Buying back shares. The net income is up. The free cash flow is up. The return on invested capital is incredibly high. It's sitting at 17% on average, as well as the revenue growth is up over the last 5 years. On the left-hand side, they have a super high current ratio. That means they have a lot of assets on hand to cover the liabilities. The return on equity is high. The EPS growth is up, and the debt to equity is super low. So for me, why am I so excited about a company getting beaten down? Everything I've been talking about, if you've been following my videos over the last several weeks, or rather months, is all coming true. Interest rates are going higher, and all these tech companies are suffering because now it's harder to borrow money. Now it's harder for these companies to actually grow and do their research and stuff like that, because now money is no longer easily accessible. And that's fine, because listen, this is all temporary. It's gonna eventually pass. This recession's gonna come, it's gonna go, but what's gonna last are recession-proof stocks. These stocks that have strong balance sheets. Now, this is where you separate the phenomenal investors from the weak investors. The weak investors are going to be the ones that are going to be selling off these strong balance sheet companies. And Google is one of these strong balance sheet companies. Honestly, for someone like me that wants to get into this company, this gets me. You could tell I'm amped. I'm amped for this because this is a great opportunity now to own a phenomenal company such as this. They own the largest search engine and the second largest search engine. You're watching this video most likely on YouTube. So if you're watching it on YouTube, like, this is one of the ways they make business. And look at these comparative numbers here. So this is what I love about this software here. You're able to just take a look at a snapshot of what the company's doing on average compared to what it's doing now. So on average, their PE ratio has been super high. So you'd be essentially buying this company at a premium. Now it's at 17.58, a super low PE ratio. So now it's almost in that value territory. And take a look at this. Super high EPS compared to a lower EPS on the 5-year average. Return on equity is up over the 5-year average. Profit margin is up over the 5-year average. The free cash flow is sitting at $62.54 billion. On average, it's 37.5. Guys, how can you go wrong with a business like Google? I don't think you can. But people are scared. But then you go over to the cash flow statements, and then you look at the annual cash flow and see, okay, what? Because this is essentially the blood of the business, folks. You trail this back. Let me see. To 2012, $13.35 billion. A little bit of a dip, a little bit, it's gone up a little bit. 16, 25, 23, 22, 30, 42, and then it just rises and rises and rises. This is a cash flow positive business. It is healthy. Then you bring it into the income statement. Now let's go on an annual basis. Let's just take a look what that looks like. The revenue, 50, 59, 66, and it's just climbing and climbing and climbing and climbing up a linear trajectory. This is a business, folks, that is one to own. For me, I love this time of year. I love when weak hands sell off phenomenal companies. And I was saying the same thing about Meta the other day. Because yes, these are all ad revenue-based companies. They make obviously their money off of ad revenue, and they obviously had a surge during, and the same argument goes for Google that went for Meta. During the COVID-19 pandemic, when everybody was at home, everybody was on their computers, everybody was on their smartphones, so they're using either Google to get to places, they're using Facebook and Instagram to connect with people. They ran advertisements like crazy, because why not? Everyone's locked into a screen to pass the time, so they're obviously going to have that surge. Now on the flip side, and where the ball has now, we're caught up to the can essentially, because we kept kicking that can down the line, where inflation's at an all-time high, interest rates are rising, people are back to their jobs doing what they have to actually do, so they're not going to be by the screen as much. Listen, folks, that's going to slow down, and that's normal. But going forward, if you are a long-term investor, you have to find companies that can weather storms. This is the start of the storm, and my bet is on Google. My bet is on Google and Meta and all these strong balance sheet companies, that they can weather this storm going forward. So when I see a company that has a strong balance sheet such as this, and the price was now, look at that, it's down like $50. Like it is down deep. What we'll do is we'll calculate the actual intrinsic value of this company. So this is the price analysis section of my software here. And what you can do here, folks, is you can do, let's say we priced out 10 years. I'm going to put different numbers in based off the historic numbers that we've been shown, and I can see what this company can do over the next 10 years to try to get a rough estimate of where this company, or what price you should be paying for this company today. Honestly, this is a super attractive price, but I'm going to fill out these lovely boxes and we'll talk about it in just a quick second, so stand by. And folks, if you are enjoying this video so far, hit that like button, subscribe button. The software that I have in front of me, you can actually use yourself. Just go over to my website, leodeleo.com, 7-day free trial, cancel anytime. And if you like it, there's a coupon code down below, Founder, for 20% off your subscription for life. So get it while it's hot. So hit the calculate button and I'll talk about what I did here. So with the intrinsic value calculator section of the software, I call it price analysis, I like putting in numbers that are reminiscent of what we have here on the board. So it goes from the 1 year, 5 year, and 10 year numbers. And I can, let's say if I want to hover around, let's say the 5 year averages or the 10 year averages, the 1 year averages, I could put those in, or I could just put in whatever numbers I think. Ultimately, the type of investor that I am, I like to try to stay as conservative as possible. So I've done low revenue growth numbers going forward. Profit margin, I've hovered around, well, this 20 and 21 mark, so that's why I did 20 on the low end, 21 on the high end. Same thing with free cash flow margin, because that matches up. Price and free cash flow, keeping it underneath 20. I like going 14, 16, and 18, and 14, 16, and 18 for a PE ratio, because that's a fair multiple to pay. Like I said earlier, folks, we want to find companies that are underneath, or maybe I actually didn't mention this, but we want to try to find companies that are underneath 22.5. Anything over that, you're essentially paying a premium for. So Google being 17.58 currently is great. And ultimately, if this price keeps going down, this PE ratio is going to get lower and lower, and it's going to hover in that value territory. So that's super important. Ultimately, we put a desired return of what we want to make, and 13% is the lucky number that I like to use. And take a look at this. $90 is current price. Average calculation comes out to $296.25. So if you pay that amount today, folks, you can assume a 13% return year over year for the next 10 years. So here's the thing. I got the $296. I want to see how low I can actually bring these revenue numbers, so to give myself the most margin of safety as possible. So I'm going to go 5, 6, and 7% revenue growth. Let's say this recession is absolutely terrible and they hardly make any kind of money. 185. Okay. Even lower, guys. 1, 2, and 3%. Let's go. Let's see. It's really making it really crunch some numbers. This is what I'm talking about, guys. 1% revenue growth numbers. Now, some people may say my profit margin, well, you're not really giving much of a discount on profit margin. And but take a look at that. From a discounted cash flow formula, $98 is what you'd have to spend today. A little bit of a margin of safety there. That's assuming. Oh, did I not go? No, I went 1%. Yeah, that's 1%, right? I thought I did 10% by accident. Yeah, so I was right. So $98.15, guys, for 1% revenue growth over the next 10 years. So this software here just takes a bunch of different multiples and stuff like that, gives you the average calculation of each and what on average you should be paying for this business. So $125, assuming that's pretty much in the 2% revenue growth range. It is selling at a discount. And people are obviously worried about, oh, what are we going to do with the ad revenue and stuff like that? Guys, I'm not saying that Google has to keep growing at the same amount that it has been growing over the last 7 years, because obviously this bull market has been super, super hot. What I'm saying is that going forward, even through a recession, even with, let's say, a slowdown in growth, this company is still in a value territory. This is what I love. I said, beneath $100 price range, I'm going to probably open up a position. I'm going to open, wow, I really stuttered with that. I'm going to open up a position, and I think I'm going to stay true to my word. And I think this is a phenomenal buy. For me personally, ultimately, it comes down to you, the individual investor. But I've been waiting for this company. I've been waiting for all these tech companies to get hammered. And I love that there's some weak hands out there that are selling this company. Anyways, folks, that's the video. To me, Google is an absolute buy. Doesn't mean you should go out and buy it. You have to do your own research, your own due diligence. This software here that I'm using helps with all of that. It's a one-stop shop. Like I said, leodeleo.com. You can use the software and try it out for 7 days free. And if you don't like it, just cancel it. Just cancel it. We have the latest news articles, the balance sheets, cash flow statements, everything that I've said, that we go back 10 years of financial data, as well as charts that we show everything from a visual perspective. And guys, can't go wrong with Google. That's my theory, at least. Anyways, folks, that's the video. Thank you so much for watching. I will catch you in the next one. Write down a company you want to see analyzed in the comment section down below. I will add it to my ever-growing list, and we'll talk about it, and you'll see it on the channel. But better yet, get the software, and you can just do it yourself. Anyways, folks, that's the video. I'll see you in the next one.